As the fiscal cliff of 2013 approaches, tax mitigation has been a heightened concern. To give you context, we here at Financial Harvest Wealth Advisors help our clients with the 5 fundamental concerns of the affluent. Number 1 being investment consulting. But today we're going to talk about tax mitigation, which is number 2. Why the heightened awareness? Let's talk about the dividends tax. In 2013, it's scheduled to go from 15 up to the highest ordinary bracket, which would be 39.6 for those highest income earners. Plus you add in the Obamacare healthcare surtax, and now you're sitting at 43.4%, which is a tripling effect of the dividends tax. Secondly, it's capital gains. When I say capital gains, I mean long-term capital gains. So as it'll go from 15 up to 20, plus the surtax brings it to 23.4. Income taxes. We know that we have bands here, but to keep the conversation simple, the highest income tax bracket goes from 35 up to 39.6, plus the 3.8% Obamacare surtax brings it to 43.4. So what does this mean to you, and what do you need to be aware of now? First of all, high dividend yielding stocks have been bid up for 2 reasons. For the last 2 years, we've seen that investors were hungry for yield. Thus, they went and buy high dividend yielding stocks, pushing those prices up. Secondly, there's now an anticipation that many of these companies that pay high dividend yielding stocks may do a special distribution toward the end of the year in anticipation of the higher taxes in 2013. Investors have already anticipated that. They bid up the stock prices even more. But once there's an anticipation of higher tax brackets or higher taxes on dividends, you'll see a flight away from those high dividend yielding stocks. Buyer beware. Secondly, we anticipate higher capital gains taxes going forward. That means that this year may be a great opportunity for what we call tax gains harvesting, where you intentionally sell the capture gains at a lower tax rate versus waiting until a future time. Third, beware of the bond bubble. We know for the last 5 years we've seen money flowing into bonds, money coming out of equities, which has dramatically produced a bond bubble. Remember, if ordinary income tax brackets go up, that means bond interest will be taxed at a higher rate, which may be the triggering effect for money to start coming out of bonds, which if you are overweighted in bonds and long maturities, you could get hurt there. And last but not least, which is the most important point, the higher the turnover that you use, if you're using active money management, the more transaction cost you have and the more tax impact cost you have in terms of short-term and long-term capital gains. That's why here at Financial Harvest Wealth Advisors, we embrace a passive investment philosophy, which pushes down on turnover, which pushes down on transaction costs, and dramatically reduces your tax bill for taxable accounts. We embrace a passive philosophy which is about 1/6 the turnover of an average actively managed fund. This puts additional cost savings and tax savings in your pocket for the investor. This will only become even more important as we move into a higher tax rate environment.